I want to bring on today's guest, Mish Schneider. Mish is the chief strategist at MarketGauge, coming to us, as always, from Santa Fe, New Mexico. Mish, a pleasure to see you. How are you guys down there?
We're doing great. I mean, all things considered with what's going on in the environment in the market. But yeah, that's the market. And then there's life. I try to keep that distinction.
No, I appreciate it as always. I mean, Mish, who better to approach things with a good sense of purpose and sense of calm. So I appreciate it as always, Mish. We had our charting forward special not too long ago, which was a lot of fun. You really added a lot of value in terms of thinking about some of the bigger picture charts and how they've evolved. We have a couple of your monthly charts to kick things off, looking at retail and looking at small caps. When you are trying to make sense of the markets in a busy week, the Fed and everything else, what do these charts tell you about conditions here?
I started out this year looking at these two key moving averages, the 23-month and the 80-month, because there is a thing in economics where you have a 2-year business cycle within a bigger business cycle. And I had a feeling coming from 2021 to 2023 that we might actually see some kind of a reset of that cycle, or at least test the parameters of it. And so granny retail, as you know, and this is what we talked about in the charting forward, was my biggest concern because, number one, as a U.S.-centric ETF with all those big box stores in it, which have made 52-week lows in many of them, where the rest of the market got through that 23-month moving average to show some level of expansion, potential growth, this never did. So that kind of told me I never really got too bullish in the market. I mean, obviously, we enjoyed the first 6 months for other reasons with tech and the growth stocks. But in terms of the whole economic picture, when people started talking about this expansion of GDP, just look here, 70%, right? There you go. So it's hard to get too excited. It's hard to get too convinced about a soft landing. And it could be the fact that XRT was not only not able to get through that 23-month, is now threatening the green line, which is the 80-month moving average. My whole thesis was on the basis of, in that 2-year cycle, do we get a brief period of growth, or are we going to go more into a recession? And as a 6 to 7 year business cycle, that 80-month measures that. We've seen spectacular moves below that 80-month as a major change of trend, long bonds being a perfect example. So if this breaks it, we'll look for some level of confirmation, like you were talking about before with the SPY chart. One day does not necessarily confirm, but if it stays below, then I would say recession will be on the lips of many.
Yeah, it's hard to imagine we would have a great recovery from here without retail at least being a part of it in some way, and we certainly haven't seen that. Small caps, on the other hand, did break above the 23-month, but then came right back within the range, right?
Well, and that's a perfect example of a confirmation. So we got 1 month, right? 2 months ago, it cleared it, but then last month, it did not. So we started to see some trouble, and we're going to talk about the calendar ranges momentarily. But in IWM's case, the Russell 2000, again, granddaddy of the U.S. economy, kind of telling us that this sector was not really buying the idea of we're going into a major growth period and the economy is looking so great, more like a stagnation, right? So now we're broken down below it, and so hard below it. This month so far in September, one of the things we also talked about in charting forward, September classically, terrible month.
Yeah.
But if, again, and granny being a lead indicator in the retail sector, if IWM then starts to break down under that 80-month moving average, we're going to be in for some tougher time.
I've already bookmarked these two charts. These are awesome, Mish, and really helpful to just think about which way we break out of that range. That could be very telling for broader market conditions. Now, speaking of which, talk us through the chart of the SPY, the QQQ, same monthly chart, very different look than retail and small caps. What does this tell you about the broader conditions?
Well, I kind of wanted to step back a little bit here on a monthly basis because, like I said, I thought this year it could come into play. And so this was really what got everybody very bullish was when we started to break out above the 23-month in both the NASDAQ, more so in the NASDAQ. Obviously, that was the big flight that we saw in semiconductors, the whole AI conversation. and fear that inflation, no fear, excuse me, that inflation was going to continue. And then there was even talk that people thought that the Fed would actually cut, and we certainly put an end to that conversation this week. So the fact now, what's so interesting is when you talk about some level of retracement, again, going back to XRT and IWM, if they continue to break down, this may not just be a retracement, but if they can hold or break down and then come back through, then these levels that we're looking at in both the Qs and in the SPYs could tell us that things aren't as bad as we think, and this was a correction more to reality. And then we can go back to sort of trading between this 4,100. I know the blue line there, the 23-month is more like 4,200. We can overshoot it a little bit, and we can go back to sort of that range between 4,100, 4,300, 4,400 until we have more evidence of what's happening with inflation. I think that's really the key here. Same thing with NASDAQ. We didn't quite make it up to the all-time highs as we can see, but certainly this is definitely in better shape than the small caps, but not necessarily a great measure of the U.S. economy.
Yeah, it's so interesting. Your next chart deals with some ratios, and I love this idea of thinking about, just sort of risk on, risk off, what sort of relative movements we're seeing. When you look at these different ratios, what does that, sort of build on what we talked about so far in terms of risk assessment or risk aversion in the markets?
And exactly what we're doing here, Dave, is we're trying to build up a conversation so that people have a perspective and not are just looking at one day. So with these risk gauges, and this is a very important conversation because right now there have been people out there who are talking about the fact that when you get the Fed funds rate and the CPI close together, then you get some level of normalization. And so in the risk environment, you really don't want to see interest rates drop much further if the SPY also drops along with it, because essentially what that means right now is we are in some level of risk neutral. We've been risk on since April. So all those corrections we were getting in June and then again in early August, we were looking at those as buy opportunities because we never went risk off. And now if you're looking at the SPY versus the TLTs, with the TLTs dropping and the SPY dropping, the SPY is still outperforming.
Yeah.
Is it wowing anybody? No, that's why we're going risk neutral. The same thing with the one below. The junk bonds, so important to look at those junk bonds, that high yield, high debt situation. They also are continuing to outperform right now the long bonds. So even if they drop, which they did obviously today along with everything else, there's a ratio that has to be watched. And the one that actually has broken down, of course, is the SPY is now underperforming the gold. Now, we saw that before. If you just move your cursor a little bit to the left there, right there, we had that one blip where gold started to outperform and then it flipped right back.
Yep.
So this is something to keep an eye on. And the other thing, as you mentioned in the very beginning, silver actually closed in the green. So the inflation conversation comes back into play when silver starts to outperform gold, and then if gold is outperforming SPY. And we can talk about that if we have time, about what kind of inflation I'm looking at now. And then finally you have wood versus gold, which is the classic, if wood is actually doing better than gold, then we're not that bad off in terms of everything we just talked about in the economy.
Yeah, and it's interesting, particularly with like the SPY, the TLT. I think people immediately think when the market gets defensive, you want to rotate to bonds. That ratio just continues to find new ways to go higher and higher. I feel like so no change yet in that trend, right? According to your chart. Now, just to finish off, Mish, I know you guys at MarketGauge just recently added some new indicators to the StockCharts platform, a new ACP plugin, which is super exciting, featuring the calendar range indicators. We're looking at gold and the VIX. Can you just briefly explain these and what they're telling you about conditions here?
Well, can we start with the VIX? Because you had talked about the VIX, and it kind of fits in with everything we're talking about right here. So essentially, if you look at the VIX right now, that green, this is the new plugin, by the way. So what's so exciting about working with StockCharts now for us is that if you layer together the leadership plugin, the real motion and momentum plugin, and then the calendar range plugin, you really can actually start to get some ideas. So everything we just talked about can retail fail further from here? Will the SPY fall further but yet find some level support a bit lower? Or are we really screwed and everything is just going to go to hell in a handbasket? Well, today, the VIX on that green vertical line, green horizontal line, broke out over its 6-month calendar range high. Now, it's been there before, got right to the 200-day moving average, which is another green line above it, a little confusing. And now here we are about to test that again. And you can see it's well outperforming the SPY in our leadership indicator. And look at the momentum just kind of went off the charts over the last couple of days. So when you put that all together, what you really have to say right now is if that continues to have a leadership role and the momentum improves, and now that it's clearing a 6-month range, and then it changes phases by a couple of closes over that 200, then we can probably argue more that risk neutral will go more to risk off.
Interesting. And what about gold here to wrap up?
Well, gold is a very interesting, look how gappy it is. I mean, it's been all over the map. But two things that really strike me is one is the 6-month calendar range low, which is that horizontal red line, and then the 6-month calendar range high, which is that horizontal green line. We're kind of like sort of dancing in the middle there with gold. And we broke down under those moving averages, which actually almost seems meaningless right now because it's been up and down and up and down. To me, what's more meaningful is the two things we've already said. One is that silver is looking like it's starting to outperform again. Two is it's showing leadership over the SPY. And three is that in the momentum indicator, we actually have we have a negative diversion. It's been under the 50 and the 200 for a while. But if the momentum starts to improve on that and we hold those calendar ranges and we can get back over that 50, then it kind of tells me that gold is not done. It's just been choppy. And if you look at it from a relative price level, it's still been holding over that 1900, which I think considering everything that's gone on is pretty strong.
Yeah, no, this is super helpful. And it's interesting with gold, Mish. It's so easy to just look at the choppiness, forget the fact that we're not far off of all-time highs. I mean, gold has been pretty high relative to where it's been here recently. Mish, this is awesome. Thanks so much for going through all these charts, particularly your new indicator. Congrats. We're super excited to have it on StockCharts. Best to Keith and everyone down there in Santa Fe. We'll talk to you again soon, all right?
Thank you so much, Dave and team.
That's Mish Schneider. Mish is the chief strategist at MarketGauge, coming to us from Santa Fe, New Mexico. Again, a big fan of the MarketGauge team, and some of these indicators I think really help to put things into context. What I love about Mish is in a week where we're talking about the Fed, I'm focusing moment to moment on how the S&P, the TLT, and other assets are doing as Powell is speaking yesterday afternoon. We invite Mish on the next day, and she's bringing monthly charts to really put things in a proper perspective. What a great dose of reality. And remember the time frame that you're trying to operate on. Don't forget about monthly, longer-term charts to really put today's movements and this week's movements into proper perspective. What a great take, as always, by Mish Schneider of MarketGauge. By the way, she was part of our Charting Forward special that we just released in the last couple of weeks. Make sure you check that video out if you miss it. Really good, wide-ranging discussion, and a lot of things have played out kind of how we discussed with seasonal weakness into September, which often happens, and it is certainly happening right now.